Good morning, all. I hope you can all hear me. It's 10 o'clock by my time here. Chairman,
Yes, sir. We can hear you loud and clear.
okay. I guess we can start.
I'm okay. I'm looking at I think we're just about 12 here. And I know we had close to, a larger number register. So, and I don't want to keep there to time waiting. But I'm not sure I can see Dr. Yvonne Afolabi is here, but I'm not sure Mr. Latunji is here, if I'm not mistaken. Our second presenter.
Yeah, it's
Paper
not
presenter.
I've not
Okay.
seen.
I've
I think we are
already
starting
prompted.
with Dr. Von.
Pardon me, sir?
Are we not starting with Dr. Von?
Yes, we are actually, but I just feel both facilitators should be on board while also maybe still waiting for maybe more members to join. I mean, left to me, because we said 10 for 10, and I don't like keeping our members waiting. We shouldn't keep those who joined early waiting because others are joining us a bit late. But if it's okay with the general pool, can we just maybe extend for maybe another, maybe we'll start 10:05. Would that be okay? Let's give like an extra 3 more minutes. Would that be okay? Is that okay?
No problem. I just want to know so I can program my own time. So, how much this time do you want to?
We start exactly 10:05. So
Yeah, good morning, everyone. It's 10:05 by my time, and I guess we can keep, keep the show running. Good morning, everyone. Thanks for joining, and welcome to Amuwo's monthly webinar session. A program, designed by the district to sort of support and assist in upskilling the technical competence of all professionals, and equally, give us ample opportunity to ramp up our credit hours for those of us that require it for validation. As usual, this is the first in the series for this year, and the issues we are speaking on today is contemporary issues in international taxation and governance. And the district technical team, as well as the executive committee, has brought two powerful presenters in the person of Dr. Von Apolabi, who will be taking us on international taxation, tax treaties, and transfer pricing and regulation. And this will be followed closely by by Mr. David Olatunji, who will be taking us on the topic of accountants as horticulturists of sustainable corporate governance. And I'm sure by the time we are done with the two participants, we will be better equipped relating to the international taxation issues and governance as it relates to our profession at the same time in supporting our clients in the various tasks that have been given to us. As we wouldn't want to take much of our time, we know it's more or less like a busy weekend session where some of us have other activities lined up for the day. The district won't be taking up much more than 2 hours for this session. Once I'm done with talking through the timetable of the event, the district chairman will come on and open the session, and we'll kickstart. The session is divided into two. We will take our first speaker, for 45 minutes. Immediately after that, we will take our second speaker. We won't take questions until the two presenters have represented as speakers in order to save time. So, during the course of the presentation, if you have questions, feel free to jot them down. And immediately after the second presentation, we will open the floor for about 30 minutes to take questions and have the presenters attend to those questions. And thereafter, I think The district will come up with some information and we'll end the session hopefully on the dot of 12 so that we can all go back and, have a much the rest of the day for other productive activities. The session is MCPD compliant, and immediately we are done, 5 MCPD hours will be credited to our respective accounts. The recording of the event too will be shared among the paid participants. And so this is wishing us a productive technical upscale session. Let me now call on the chairman to declare the event open. Thereafter, we'll take the anthems and then we'll have his opening remarks. Chairman, over to you.
Thank you so much, Mr. Michael Atishe. Thank you, sir. We're grateful. I don't know whether you can see and hear me. Can our members hear me and also see me? Okay, I think we can. All right. Thank you.
People, so go ahead.
Okay. Sir. All right. Thank you, sir. Once again, I'd like to say welcome. Thank you, everyone, for joining and keeping to time. And I guess since we're still in January, I can still say Happy New Year. Or is it better to say compliments of the season? But either way, we're grateful and we know it's going to be a wonderful year, 2025. Without too much further ado, I hereby declare this session open. Thank you, everyone. Over to you, sir.
Yeah, thank you, Chairman. So we will now take the anthem, first by the national anthem and then the ICAN anthem. The ICAN anthem.
Let's go, ICAN fount of treasure in triumph of an race, standing stronger in harmony, building a land together. Dreams of a founding fathers, we are striving to attain. Our dreams and values that we share through all ages be sustained. Institute of Chartered Accountants of now.
now that we have the anthem out of the way, we will now have the opening prayer, which is the second stanza of our old national anthem. O God of all creation, direct our noble cause, guide our leaders right, help our youth be put to know, in love and honesty to grow, and living just and true. Greatly lofty heights attain to build a nation where peace and justice shall reign. Thanks for your time. Now we'll now take the chairman's opening remark. Over to you, Chairman.
Thank you so much, our wonderful and able moderator, Mr. Michael Olatish FCA. We're grateful. Thank you for your service to the district and the institute at large. Once again, good morning, sirs and mas, my elders on this call. I can see my pioneer chairman is here, Prince Abayomi Ogunjimi, and other past chairmen. Permit me not to go into full details so I don't take too much of our time. But what I just want to say is a big welcome to everyone. Thank you for always keeping to time and for subscribing to our knowledge sharing program tagged our monthly webinar. As you know, the aim of this program is not to make profits, it's our own means of contributing our little quota and equipping our members. And I would like to, at this point, maybe just brief us of a particular situation. Ideally, this webinar is supposed to be coming up twice every quarter. As say in the first quarter of this year, we're supposed to have it January, February. Then in March, we leave that blank for the Western Zona webinar, since we belong to the Western Zone. However, yesterday, we got an information from ICAN, which more of or less took the price of accrediting the webinar from, without divulging too many information, say maybe the webinar used to cost 50,000 naira, and now they are saying it's going to be costing about 200,000 just to get accreditation. And I'm sure, ladies and gentlemen, you can tell that the fee we are actually charging is more or less just to, fix a little thing here and there. Not that we're actually charging or even paying our resource people what they actually would maybe earn if they go deliver these lectures in maybe Lagos Business School, or maybe charge what they're supposed to be charging us per minute or per hour. So with that information out there, we would definitely, after today, communicate to you the mode at which our webinars will go on henceforth. Probably we'll be doing once a quarter, or by God's grace, maybe we'll get somebody in here who might probably want to be facilitating our accreditation fee, so we can keep equipping our members, and just because we know that learning, unlearning, and relearning is very, very essential for accountants and general human living. On that note, I also like to sincerely thank Dr. Ivana Falabi, who's here, and also Mr. David Olatunji, who's also here. The paper facilitators today have been specially chosen to ensure we have a wonderful time. And just like the moderator had rightly said earlier, we usually don't like taking too much of our time. We are ICAN Amuwo District Society. We are the vanguard of integrity. So whatever we do between now and 11:45 thereabouts, take questions. Be rest assured that by 12 on the dot, we'll be wrapping up. So sit back, relax, get your pen and your notebooks, be ready to take as many notes as possible, and be ready to ask questions from our facilitators when the time comes. Once again, thank you so much, everyone, for being here. Thank you to the technical team. Thank you, Mr. Latishe. Over to you, sir. Thank you.
Thank you, Chairman, for that wonderful opening remark and notification. I'm sure our members, we all know what's going on within the country. We all know what is impacting the various stuff. And we pray for increase in people's inflows as well. So this is my own prayer to the executive committee, irrespective of whatever cost will be. If we can make this a monthly event, whatever price that we can pass on to the members, I'm sure most of them will probably be willing to accommodate. And by luck as well, if we have members who will be willing to take the burden of the accommodation, the accreditation from the districts, and allow the district to continue to subsidize this valuable training session. I'm sure we will all be supporting you, whatever little way you can, just to keep this technical upskilling up and up and going. Without wasting much of our time, I will now call on our first paper presenter in the person of Dr. Von Afolabi. And while she prepares her slides for presentation, I will quickly run through our bio just to introduce her to us. Dr. Von Afolabi, I hope I'm not murdering your name. Has over 12 years experience starting to commence her career with the federal government World Bank projects, where she had her service there as an auditor in an audit firm and launched out afterwards in the banking sector. The old Diamond Bank, now pristine the Access Bank. She later moved on, into the entrepreneurial hub, where she had a stint as a short-term finance consultant in an NGO. She moved back to practice in the advisory division of a firm of chartered accountants and later an auditor, majoring in tax as a tax personnel. She became a corporate tax consultant, tax specialist in auditing, transfer, and also served as a tax manager and business in Dangote Sugar and Refinery, focusing on seeing conclusion of tax audit exercise. He also worked with Creston Fedabo as a tax consultant, covering various subject areas within the firm. And she worked with the special, she was also seconded to FRS headquarters in Abuja, where she worked with the special advisor to the executive chairman on legal counsel compliance within IFRS. She's well loaded with so many certifications, both in accounting and taxation, finance generally. I'm sure we'll have lots and lots to definitely pick up from her. She's presently the principal consultant, Tech Point Finance Consul, and equally an ex-PwC. So you are welcome, Dr. Von Afolabi. You have 45 minutes for your presentation now.
Okay, thank you very much. Please, can you hear me?
Yeah, we can hear you.
Okay.
You can equally share your slides.
Yes, I want to share my screen.
So I hope I got your name right while that's your page is coming up. Von, right?
Von.
Okay,
Von,
it's
yes.
Von. Okay.
Von. Please, can you see my screen?
I think still coming up. Not yet as of this moment. We can see your video.
Okay. Can you see my screen now?
Not yet.
Okay. You can see it now, right?
Yes, we can.
Okay. Good afternoon. Good morning, everyone. My name is Dr. Yvonne Afolabi, and I'm here to speak on the topic international taxation, tax treaties, and transfer pricing regulation. The topic on its own can write a very big textbook, but I'll just try and give high-level summaries for us to have a good understanding that if you are called tomorrow to talk about it, you can say one or two things for at least 10 minutes and more, and they will know that you've actually come across the topic before. So the major headers will be on the introduction to international taxation, tax treaties, that's the fundamentals of tax treaties, key elements of tax treaties, OECD model, tax conversion. Then we'll now move to tax treaties, different from transfer pricing, just that they are both international based. So the transfer pricing regulation, we'll talk about the basic concepts, the documentation requirements, and transfer pricing methods, then recent developments, and then conclude on it. International taxation actually plays a very vital role. Just imagine each country, we're just talking about their local tax. What happens when you are doing cross-border transactions? So it's very important. We're not just knowing about company income tax or children profit tax, we're also knowing about things related to cross-border transactions. And tax treaties and transfer pricing regulations are cornerstone components of international tax. So if you're talking about international tax, you're talking about tax treaties, and you're talking about transfer pricing. It aims at promoting cross-border trade and investment while preventing tax evasion and double taxation. So most of the two things it's trying to prevent everywhere in this document, it will be shared to you after this session, is that both the tax treaty and transfer pricing, they are there for a purpose. They're there to prevent tax evasion because we are human beings and we are very wise. So there are lots of ways companies and individuals can actually evade tax. And it's also trying to prevent double taxation, especially for the tax treaty. So we move now to tax treaty on its own. Tax treaties aim to prevent double taxation and fiscal evasion by establishing clear rules for taxing income and profits earned by individuals and business across the borders. And the funny thing about tax treaty is that Mr. A may read it, Mr. B may read it, Mr. C may read it, and you have three different interpretations. So it's always good to always refer back to the tax treaty to ask yourself, what did it say about business profit? What did it say about royalties? So that you always have a backing in section 2 of the Tax Treaty Act. And if I ask people here, how many people have looked at the tax treaties? Some people feel it's so elaborate that where do I even start from? I have everything on my system here. And funny enough, they arrange tax treaties in the same way. Article 1 across the 15 countries is the same title, Article 2, Article 3. So it's well organized so that you know that, okay, every Article 5 is business profit all across, because I opened 3 different treaties here to show a sample when I'm done with this topic, to show that it's actually very easy to understand these tax treaties. Read it one after the other just to understand, because it really changes unless there are significant updates per country, but not all the countries being changed at the same time. So tax treaties establish rules for taxing different types of income, such as business profits, dividend, interest, and royalties. So they don't just tax everything at the same time. Different types of income have different ways of treating it. So what's the purpose of an objective of tax treaty? To establish a fair and equitable system for taxing across border transactions. And the primary objective is to prevent double tax, fiscal evasion, and tax avoidance while promoting international trade and investment. So what's the legal framework? Because every law in Nigeria, in the world, have laws that are backing them, every principle. So the law backing tax treaties, OECD model, OECD 2 are the ones that also do transfer pricing. They are always actively doing what they know how to do best. OECD is the Organization for Economic Cooperation and Development. So the legal framework, international tax is governed by a complex legal framework comprising of bilateral tax treaties and multilateral agreements and domestic tax laws. So we have 2 types of tax treaties. We have the bilateral and the multilateral. Bilateral is between specific country peers, while multilateral, it cuts across borders in the world. So we have 15 list of countries we have tax treaties presently. We also have Italy, but it's not the full package. We have in Canada tax treaty. There are different documents, just very brief documents per country, because most people have not even looked at it. Some people may not even have seen it before, and they're chartered accountants and shouldn't be. So I endeavor you that after this training, you just look out for it, and you could also zip it to the chairman here so that he could share with his member, just to ensure every accountant has it on his or her system. The countries include Canada, China, Belgium, Netherlands, Czech Republic, France, Pakistan, Philippines, Romania, Singapore, Slovenia, South Africa, Spain, Sweden, and the United Kingdom. These treaties aim to prevent double tax, as I've always said, and fiscal evasion, while promoting, so while they are preventing something, they're also promoting cross-border trade and investments. I wanted to just show the samples of the tax treaties. Can you still see my screen? Did it change?
For now, it's still the initial screen we are seeing, ma.
Okay. Right. Let's give it a second. It's just a second. Because I always like to be practical about these things. Okay. Share. Okay, you can see the tax treaty now, right?
Yes, we can. Thank you so much.
Okay. So I opened 3 tax treaties down to show the similarity between all of them. So it's not really something so technical that is scary that some people don't actually want to look into it. So we have like for every, this is a tax treaty between Nigeria and Singapore. This is tax treaty between Nigeria and France. This is a tax treaty with Canada. And if you look at Article 5 of the one between Nigeria and Singapore, you see Article 5, permanent establishment. If you go to Article 5 of the one between Nigeria and France, Article 5, you also see permanent establishment. And if you go to the one with Canada, Article 5, you also see the same permanent establishment. So what you're saying, A, B, C, maybe the same, but there will be some clauses that some countries have said yes to, while some said no to. So when you're talking about tax treaty, you ask what's the country, then you go to that particular tax treaty and see, okay, permanent establishment here, is it branch, is it office, what did they remove? So across board, Article 4 is the same, Article 4, physical residence, it's the same across board. So they made it so self-explanatory. So that once you've known that Article 5 is permanent establishment, it's already in your head. So any tax treaty has the same header. So it makes it easy to assimilate and understand. And there are not so many articles. So before you know it, you already know the headers of the different articles, which are same across all the 15 tax treaties. So let me go back to my slide to continue the session. Please, can you see my slide? Hi, please, can you see my slide?
Yes, you're back on. Yes, we can.
Okay. So the next key elements of tax treaties. So we have residency rules, we have permanent establishment concepts, we have income characterization, we have methods of double taxation. And I think one of the most interesting parts of the tax treaties is on permanent establishments. There was one VAT monitoring I was attending, and the tax officials were saying, okay, permanent establishments, even though there is no physical office, once the place of consumption, so place of consumption came out, that once there's a place of consumption in that particular country, if maybe the workers are actually in Nigeria and they are consuming it there, then there's a permanent establishment. So there are a lot of arguments, even some will not be in any law, but they just come up and just keep arguing based on what they feel is right, based on that particular scenario of the particular taxpayer. So we have residency rule, we have place of permanent establishment. Residency rule is a place of permanent, a place of consumption can also trigger a permanent establishment. So the major issue on this key element is permanent establishment. So permanent establishment is when a non-resident in a country becomes taxable. So it's not necessary that you must have your company coming all the way here. No, if you just have one representative and he has an office space, it actually creates permanent establishments. Like if you look at it in if you look at it in one of the treaty documents, you will see the full, you will see and it's actually very important you understand it all so that you will not be in a tight spot when you're talking to tax officials and they're telling you what constituted a tax permanent establishment and you're arguing with them and they tell you to go to the law. And it's always said that ignorance is not an excuse. So we have income characterization. That means, is it business profits? Is it dividends? Is it interest? Or is it royalties? So we have methods of double tax relief too, which is exemption method or credit method. So the OECD model tax convention provides framework for countries to negotiate and conclude tax treaties aiming to eliminate double tax and fiscal evasion. So that particular instance was the fact that they wanted to charge VAT on the services that the expatriates were carrying on in Nigeria. And our argument was that the parent company was abroad and these people just come and go. So we now say, okay, they come and go. Then the next question was now, how many days did they stay in Nigeria? So tax is very dynamic. Once you say A, the tax officials speak it again and say, okay, no problem. Say they are going and coming, where is their flight in and out? How many days they stay? And if they stay above 183 days, they stretch, then such services are taxable in Nigeria. So permanent establishment rule is very important for everyone to know, to be able to argue cases of tax treaties, VAT reviews, VAT monitoring, index reviews, or tax audits. The model includes taxation of income, capital, dividends, as well as transfer pricing and AEOI, that's an automatic exchange of information. The key provisions in the tax treaties are article, that means there are a lot of articles, but the 5 most important ones are Article 5, which is permanent establishments, which is always the first topic in any tax treaty case. Then we have Article 7, business profits. We have Article 9, associated enterprise. And we have Article 26, exchange of information, whereby if you're trying to hold your information, FRS has the ability to ask another country to give them the information they need, since you don't want to share maybe such foreign bank statements. And tax treaty is very interesting, actually. If you decide to delve into it, you see that it's an aspect that is dynamic. And once you know it because it really changes. And or even the new Nigerian tax bill that's coming out doesn't actually affect the details inside it. So it's a thing that is like cast on stone. And just knowing the articles and how to argue about it. Is it digital transaction? Is it not digital? Those little items will make you a tax treaty expert in the field. So that is majorly on the tax treaties. So tax treaties, when you hear it, it's all about treaties between Nigeria and another country. Then inside the treaty itself, there are different articles, and the different articles, okay, if you may have an issue and maybe it's only Article 5 that is addressing it. You don't need to read the whole double tax treaty agreement. So you just go to that particular article and argue your point from that particular article. And since it has different headers, by the time you know, okay, you're treating an issue between Nigeria and Canada, maybe your client has a Canada base, you say, okay, let me go to tax treaty agreement between Nigeria and Canada, look through all the headers, you will see the one that actually addresses the issue you're talking about, because once it's not there, then it means it's not covered. So you have to argue your case based on what is written, because it's a law. Law is based on what did you see, how we arguing it based on it. And even within those whole explanations, there is still always further arguments, and they may win even outside what is written in the article, based on the present issue on ground and what is realistic and all. I can hear you.
Dr. Ivan, your slides
Can you hear?
Your slides not moving. Are you changing it from your end or just stationary?
Okay, please, what can you see now?
It's still your cover page.
Are you serious? Wow.
Yeah.
Okay. Sorry about that.
No problem.
I'm moving my slides from here.
Maybe you want to put it on slideshow so that will sync it with what you are sharing.
You're sharing the wrong screen. You can see transfer pricing now, right?
Yeah, slide 9.
Okay, so you're sharing the wrong screen. Okay, thank you. That's okay. So we're moving to transfer pricing. So to get more information on tax treaties, is just to get the 15 local tax treaties, read through it, even just read through the headers, write everything out and get knowledge about that. With that, to be able to cut across the different tax treaties, and the interpretation could be different from person A to person B. So we move to transfer pricing. These aspects of tax are very interesting. It's good to know that almost or will I say it's good, is pathetic to know that a lot of chartered accountants really don't know anything about transfer pricing, tax treaties, some particular very important issues. Just like Donald Trump that came just last week and was already trying to remove United States from the global minimum tax. And it's our hope that our chartered accountants understood it, but it's reality that most people don't actually delve into transfer pricing or tax treaties. So it's always good to have such trainings so that from time to time, by the time you keep learning it, you understand the terminologies. Transfer pricing is basically the price you're selling between related parties on arm's length basis. So for tax treaties, the most important word is permanent establishment. So for transfer pricing, the most important word is what you're selling at arm's length basis, e.g. maybe Dangote, we have Dangote sugar, Dangote salt, Dangote flour, Dangote refinery. They could sell between themselves. Are you selling at arm's length principle? And some people actually are not. So that's why the transfer pricing came on board to ensure that companies are doing the right thing. Arm's length principle is what's the price they're selling in the market? Is it the price you are selling within yourselves? That's actually what's the layman definition of arm's length principle. So fundamental concept in transfer pricing requires that transactions between related parties must be priced as if it occurred between unrelated parties. That's the major word in transfer pricing. And is the OECD transfer pricing guidelines that back up transfer pricing. We also have OECD country by country reporting, where we now have to do it master file and local file. So in a normal June 30th filing, you have the disclosure form, that's purely transfer pricing. We have the declaration form, that's you are declaring your directors, which does not occur every year. Depends on when you change a new director, then you now fill an updated declaration form. But disclosure is every year. Then we have country by country reporting for those that have subsidiaries outside the shores of the country. Then can now talk about a master file and the files that are created across each subsidiary, where the master file is mostly where the headquarters of the company is. So my present slide here is on the transfer pricing methods. So in the disclosure form, the normal filing, what people naturally know is the disclosure form, the declaration form, documentation is the full breakdown of these methods. Which method did you use? They'll break down the pricing. They do like cost analysis in that documentation to fully explain the information. So now the methods don't actually show up in any form, just that these are what guides your choice on the method you are using that you will now declare at the end of June 30th. So these are the methods guiding, okay, am I using cost plus method? Am I using comparable uncontrolled price? Am I using resale method? Am I using TNMM? So these are the methods you choose. You can't use all at the same time per transaction. Maybe cost of sales, I'm using cost plus to sell from sugar to salt. I'm using the resale price method. What price am I selling? Are they selling it? If I'm a buyer and a customer comes to my shop, what's the resale price? That's the price I pick to use in my company. Or is it the comparable uncontrolled price? So there are 5 methods for transfer pricing, and then we're going to discuss it further here. So we have documentation requirements, that's 3B. We have that's the OECD country by country reporting. We have the master file guideline, the local files. So local files are in Nigeria, in Ghana, in Sierra Leone. There may be a master file is in the US, maybe where their parent company is. So we have just one master file and several local files. So this is what I've explained in order to save time. So we have country by country reporting. There's also a form that is filled also for June 30th or 6 months after accounting year end. And it's actually a very simple form to fill too, just like disclosure forms, declaration forms. People are so scared to either they could just call you, come and help me fill. And if you just read it, you see what's the name of your director you put. Did you transfer anything between company and company B? No. But because some people just see the big name, country by country reports, and they are shaking, but it's actually very simple things, and the forms are actually so easy. It's now online, and it's very easy to understand. When I first started transfer pricing, I read it through by myself and understood before I was not trained by foreign people, but it's actually something you can actually understand just by looking through what they asked. If you know how to read a financial statement, then you definitely know how to fill disclosure forms, declaration forms, especially the disclosure form, because you have to read through the financial statement from beginning to end. So chartered accountants can be a good transfer pricing specialist. But most people don't know transfer pricing is not really about tax. It's mostly about the financial statements. What's the cost of sales, the breakdown of the cost of sales between subsidiaries, the breakdown of profit. So everything is about the financial statements. And chartered accountants could be good in this specialty, because I've been through it. Then the different methods of which I put example for us to understand is the comparable uncontrolled price. We call it the COP method. It's between a related party and an unrelated party. It relies on identifying comparable uncontrolled transaction. That means what you can compare with an unrelated party, but is not controlled in the open market. So it's mostly used when the data is available. Maybe you are using the industry standard. So if you don't have that industry standard, maybe it's too costly to purchase, then you can't use the COP method. So the tax authorities allow you to choose any method as long as you can argue why you used it. So if you say, why didn't you use the COP method? You say you didn't have any comparable data to use because it works based on data from an unrelated party. Just imagine you're Dangote and you need the information from Bois Cement and you don't have such information, then you can't use the COP method. But if you have such information of your competitors, then definitely you can choose to use the price they're using there and adopt it in your own. So the example here is a US subsidiary of a German parent company manufactures auto parts. The COP method can be used to determine the transfer price for these parts by comparing them to similar auto parts sold by independent manufacturers in the US market. That means you just go to the market and say, how much do you sell this pack of biscuits? They say it's 500 naira. You pick that price. It's an uncontrolled price. You do not influence what the person is about to tell you. That's the COP method. When they share the documents, we look through at the second examples. I'll just stay on the first examples of the methods. The second one is resale price method. So all of them are trying to determine arm's length price, the price you're charging for cost of maybe raw materials between company A and company B under the same umbrella, under the same parent umbrella. So this is done by subtracting gross margin from the resale price of a product or service to ensure that the reseller is selling it at arm's length. It's mostly used for distributors and retailers. Maybe you do bulk purchase. On a normal day, if a retailer comes to buy from a wholesaler, he will add profit to it. So now, if you are adding this profit, what guided that what you are adding? So that's the resale price method. Is it at arm's length? That means in the transfer pricing method, you have to go to the market, that's the third parties, to find out how much are you reselling. Because even sometimes, especially during this regime, as inflation has been occurring, maybe a tin of sardine is 1.2, and suddenly you go to the same shop is 1.6, and you ask, what fueled this your price increase? You say, my other colleagues have increased it. So It's always information outside in that market space. So you have to find out how much are you reselling this item? Is it more costly than what I can get in the outside market? If the answer is yes, then what the tax authorities now do is they will recalculate the real price of that thing, because on a normal day, if you sold it high, it means your cost of sales will be high. So they recalculate the cost of sale, recalculate your revenue, cost of sales, get a new gross profit, get a new net profit. And with that, there can be an tax liabilities from that recalculation. So that's what brings tax authorities into this transfer pricing. They help you, after the argument, maybe a transfer pricing audit, they help you recalculate this thing based. That's why I said the financial accountant can do well in transfer pricing, because you know all the lines of a financial statement. So by the time they finish and you argue everything, it may lead to a lower tax liability or a higher one, but they are aiming to reduce your costs, increase profit, so that there will be a income tax liability at the end of the day. So it's tied with income tax liabilities when it has to do with transfer pricing. Then an example here is a US subsidiary of a French parent company distributes luxury handbags. The resale price method can be used to determine the transfer price for these handbags by considering the resale price charged by the US subsidiary to its customers and deducting a reasonable gross profit margin. That means in this one, you're trying to make a margin by adding an amount to it. So you always ensure that it's not overflooded and far higher than what you can see in the open market. And as I said before, the tax officials allow you to choose the method you want to use between subsidiaries that are mostly producing things. So sometimes in a disclosure form, it's not necessary that you must fill something that led to a transfer price. And some companies may not really sell between themselves. So you just put your normal cost of sale. Did they sell between related parties? The answer will be new. So you put the normal ones on the financial statement, while things related to transfer pricing can still be new. So there are some disclosure forms that are always new. You just put the normal figures that way in your financial statement that are from third parties, if none is from related parties. So the third is a cost plus method. So cost plus method is always an easy one, whereby you bought something 10 naira, you add your margin and you sell it 15 naira. It's mostly used in manufacturing and services transaction. So now your type of industry will make you know the type of method to also use. If you're a manufacturing company, you can use the resale price method. If you're a wholesaler, and if you're a service transaction company like a consultant, you can use the cost plus method. So the type of industry to assist. So when you're learning the methods, you also learn the type of industries tied to such methods so that you know how to advise companies. An example here is a US subsidiary of Mexican manufacturing company produces raw materials. The cost plus method can be used to determine the transfer pricing for these raw materials by adding a markup to the cost of production, including direct materials, labor, and manufacturing overhead. So some people just run to this because it's very easy to explain to the tax officials that you just added to social profit. But always still ensure that is based on what is in the open market. So before companies take decision on pricing, like in Dangote Sugar, Dangote, so they hold elaborate strategic meetings, go to the open market, find out how much is bar sugar, how much is bar salt, to ensure that you are saying the same thing in the markets across board. The fourth method is transactional net margin method. It's all the methods aim at determining the arm's length price between related parties. So it compares the net profit. So this one is dealing with net profit, while the other resale was dealing with the gross profit. So this is profit after tax, and by a taxpayer to the net profit margin, and by comparable unrelated price. So you're comparing your net profit margin with another unrelated party. Maybe that's from Boa to Dangote. You're comparing yourself based on the net. That means you go to the net profit to calculate it backward, while the other one, you go to your gross profit and calculate it from there. So this method is flexible and can be used for the various types of transaction. It's mostly used when other methods are not applicable, because you can't be determining your cost of sales from net profits. That's like after you've determined a lot of admin expense, you now start determining cost. So this is like the last resort when we are dealing with transfer pricing methods. So the example here is a US subsidiary of a Japanese electronic company provides research and development services to its parent company. The transactional net profit margin method can be used to determine the transfer price for these services by comparing the net profit margin of the US subsidiary to the net profit margin of comparable independent research and development companies. So this time around, you're looking at the net profit legs between your subsidiary and another subsidiary in the same country that is not dependent on you. That's the method. Then the last method is on profit split method. The profit split method is used to determine arm's length prices by splitting the combined profit earned by related party from a controlled transaction. That means you didn't actually determine any price. You just say, okay, this profit, this one goes to salt, this one goes to sugar, this one goes to flour. You divide the profits and just split it. So maybe there was a profit sharing ratio. We didn't take any cost into consideration. We're just splitting profits. And it's mostly used for joint ventures and highly integrated transaction, whereby it's too integral, maybe like oil company, maybe NMPCL, NEPL, like it's so integrated that for you to start thinking of cost at those little units, it's hard. So you just wait and split profits and get that method using that particular approach. So it's mostly based on companies that have a lot of high transactions. An example here is a multinational pharmaceutical company has a global R&D division and a global marketing and sales division. The profit split method can be used to allocate profit between these divisions based on their relative contribution to the overall value chain. So you divide it, what percentage this one contributes, what percentage this one contributes, divide it and now share the cost of sales across board, which is actually easy for such high rate integrated transactions and businesses. So those are the major things related to transfer pricing. One is the 5 methods. Why the second is, so the 5 methods are mostly used in the organizations that have related party transactions. So now the disclosure form, there are 3 forms filled by every consultant. 6 months after accounting year, we have the transfer pricing disclosure form to disclose any transactional related party events for that particular FY. So it's FY to FY. The declaration form, if you have first filing with FRS for transfer pricing, you fill a declaration form first and list out all your directors, shareholding, everything related to the company. So if you are doing it next year and no director change, you don't necessarily have to fill a declaration form. You just fill only the disclosure form. Then documentation is for companies that have a annual gross turnover of 750,000 euros. So it's not for all companies, not every company that fills transfer pricing documentation. It's a file, it's a real document where you talk about your price to the very details, but it's for those that have such gross annual revenue for the year. That's 750,000 euros or 160 billion. But I believe that billion amount will change because of the current exchange rates per euro. So the few ones I'll just run through here after those 2. Then we also have the OECD forms too that people fill. That's the country by country reporting that people feel. That there's also a common reporting standard that's just for banks. They fill it by May of every year. That one too has its own form, just a pager form. All those forms are always very easy if you just look at them. The financial accountant will definitely be able to dissect those forms and fill it appropriately. So the recent developments and challenges in the space are BERBs, that's base erosion and profit shifting. For a lot of companies do a lot of strategic thinking, shift it to low tax regions. That's the cost of sales, why they bring the revenue to countries that have low corporate income tax percentage. So there are a lot of strategy among related party transactions. And FRS, the tax authorities woke up from like 2018 to see that a lot of monies were being moved out of the country. They were not taxed because there were no transfer pricing rules in place. So from 2018, we started doing transfer pricing, and they even have departments in FRS, in the headquarters and regional offices and local offices where they go around for transfer pricing audit. That's just for companies that have related parties. So the base erosion and profit shifting was initiated by OECD to also avoid tax avoidance strategies used by multinational enterprises. And it has been able to achieve a lot to ensure that profits are not shifted to low tax jurisdiction. We also have the digital economy taxation. That one too is mostly dealt with in tax treaties too. the digital economic taxation. So people may be transacting on the system and making a lot of money on system by just, you don't need to do anything. From America, I'm transacting business here, I'm making money. So FRS have woken up to also ensure they tax the digital economy, because that's the area too that was still growing in the country. So we have compliance and risk management too. For every principle, every law, there is always a compliance measure and there is always a risk management. So the compliance is in the disclosure, the declaration, the documentation, country by country as it is, and there's a compliance framework to ensure that the framework includes filing requirements, just like I've mentioned, such as tax returns and transfer pricing documentation, as well as audit defense strategies. So it's also a good thing that as we also adopted transfer pricing, we are also doing tax audits on transfer pricing. And also Nigeria too has adopted the automatic exchange of information, AEOI, whereby if companies have proven difficult to get information, they get information across those countries where they've been informed that they have subsidiaries. We also have the advanced pricing agreements, an agreement that delves into those methods and to advise taxpayers on methods to choose. So those are the major things about the transfer pricing, the methods and the forms to fill every financial year. And the liability of not filing is 10 million naira the very next day after you don't file. They've not really, it have been implemented through some beg, but it's there in the law that it's 10 million naira if you don't file. If you have related party transactions and you don't file, and those forms are just another 30 minutes, you can fill it. And because of 30 minutes work, a tax consultant can make a company to pay 10 million if they are not informed of the right thing to do. But if the company has been negligent, sometimes FRS opens the gate that, okay, come and file backlog, and there won't be any liability or penalties in this space. And there's also some environmental tax consideration. And the most important thing is the global minimum tax. And it's so interesting how USA wants to back out. I had a judge has overruled his executive order, because I don't see whereby the country agrees on something today, another president comes, removes it. So if Donald Trump goes again, they remove it. A law should be a law that should just stand, not executive orders just sweeping and waking and confusing the tax system. So we'll see where that is going to lead to, because USA is actually a powerful country in the world and it may influence, although Nigeria too has not signed the global minimum tax, that's charging 15% across board for company income tax in the world. So that's been the most contemporary issue in the space concerning transfer pricing and all. And that is it. In summary, the national tax is a complex and evolving field governed by tax treaties and transfer pricing regulations. These regulations aim to prevent double tax, like I said earlier on, tax evasion and profit shifting, while promoting cross-border trade and investments. In conclusion, the national tax is a critical aspect of global business operation. Effective management of international tax obligation demands a deep understanding of complex rules and regulations. Just imagine you don't understand the methods, then you can actually help a company on transfer pricing issues. So it needs more and more learning to really understand each of these terminologies, both in the tax treaties and for transfer pricing. So I think I'll stop here. Thank you very much for your time.
Thank you, Dr. Afolabi, for that presentation. I'm sure our members are taking notes and will probably be coming with their questions immediately after our second presentation. So we apologize that we have to keep you waiting. We don't want a situation where the questions and answer session takes longer than necessary. So we'll take the second presentation now. Immediately after the second presentation, we have 30 minutes for question and answer. And then I'm sure by then, questions will start flowing in. And if any of our members, would like to drop their questions without necessarily waiting for the audio version, you can drop them in the chat box. Dr. Falabi will be able to see it as well. And if she needs to respond before the question and answer session, I'm sure she will do that in the chat box. Thanks once again for that presentation, and we'll get back to you. So we'll now go on to the second presentation, which will be delivered by Mr. David Olatunji. While he prepares his presentation slides, let me quickly run through his bow. Dr. Mr. Olatunji, I think he was there earlier.
Yes, he's still on, Mr. David Olatunji. Thank you, sir.
Okay. I think he lost or maybe changed the handle. Okay, he should be able to unmute himself now and prepare his presentation. Are you available, sir, Mr. Olatunji?
Oh, yes.
Oh, okay.
I've been trying to unmute myself.
Yeah. I think you changed. I know I gave you a co-host earlier, but at least it's sorted out now. So while you prepare your presentation slides, let me quickly run through your bow to the audience so at least they know the quality of the presenter we have brought to them. Mr. David Olatunji FCIS is an accomplished educator, trainer, keynote speaker that comes across various training sessions, retreats, and conferences. He's a world-leading authority when it comes to leadership and governance. He has trained several individuals across different sectors and companies, both in the private and public sector. He's a board advisor on good governance and also a governance auditor for organizations. So any of us that requires corporate governance auditor, you can reach out to him. He authors a corporate governance textbook and has received intense training across different continents as well. He runs a David Olatunji Leadership Academy, the learning hub to train individuals and organization and alumnus and members of Lagos Business Schools and various chartered organization as well that includes other secretaries and administrators of UK and that of Nigeria. He's on various organization faculties, Phillips Consulting Limited, ICAN, Institute of Chartered Secretaries and Administrators of Nigeria, and the Chartered Institute of Directors as well. So I present to you Dr. Olatunji, who will be speaking on accountants as horticulturists of sustainable corporate governance. Over to you, sir. You have 45 minutes for your presentation. Mr. Olatunji, can you hear me? You are muted, sir, in case you are speaking. You can see your slides, but we can't hear you.
Okay. Can you please see my slides now?
Yeah, we can. And we can hear you now, sir. Go ahead.
Okay, thank you so much. And good morning, distinguished professional accountants. It's always a pleasure to be invited to discuss, topical issues with things that are very current. And one of them is this sustainable corporate governance. And the topic we're looking at for the next 30 minutes or so will be accountants as horticulturists of sustainable corporate governance. The slides actually are about 50 slides. And of course, there's no way I will even go through the 10 first 10. So what I sincerely think will happen will be I will give a summary, like an overview of everything through the learning outcomes, through the content. By the time I'm sharing the learning outcomes and the content and the synopsis, I will try as much as possible, to summarize the whole thing because it's actually very good topic for now that accountants need to get, skills on horticulturist of sustainable corporate governance. We can actually also say that they are gatekeepers or gardeners, of corporate governance, especially the one that is sustainable. Now, I always like to start this, even though I don't have enough time, it's very important. I'm so excited when the chairman was talking about knowledge sharing platform. I have this, almost 2 decades ago, and I'm sharing on uh, every single learning intervention that I'm engaged in. The illiterate of the 21st century will not be those who cannot read and write, or those who cannot learn, unlearn, and relearn. Life is about relearning new things, especially for professional accountants. You see, knowledge actually becomes obsolete. 25% of the knowledge you have become obsolete in every 2 years. And so you need to always make sure that you're on top of the game. Now, for accountants this year, for instance, you should now begin to think on how to gain more knowledge on artificial intelligence and how this thing will affect your profession in the future. Today, we have so many people developing apps for accountants. They are not accountants.
Hello, Mr.
But they
Latunde.
develop. Yes, please.
Hello, Mr.
Yes,
Latunde.
Chairman.
Your your audio is very faint. I don't know if it has to do with your system or your mic. If you
I don't
can
really.
be louder, it's
I,
very faint.
I hope it's not from your end. Because I just changed systems, really. When I was listening to Dr. Folabi, I wasn't hearing her well. So I had to now change to another system. So I hope
Well,
it's not
I
in your
think it's a general one because even from the chat room, that seems to be the general complaint from everyone that the audio is low.
I don't think it's from here, sir. The audio is I have two sets now that are very, but I have, so I think it should be from that end. But I will I will increase my own voice.
Okay, maybe that will be.
Okay. All right, so let me move here. This is a quote from John Wolfensohn, the former president of the World Bank. The governance of the corporation is now as important in the world economy as the government of country. We all know that governance is not management, governance is not administration, governance is exercised from the top by the board members, the board of directors. And of course, the board of directors cannot do anything without the help of the professional accountants, without the accountants giving them all the figures, giving them all the insights, giving them all the direction and the leading that they need. There is no board that can actually succeed, without the accountants. And in the wake of corporate failures in the United States in the early 2000s, Arthur Leavitt was the chairman of the Securities and Exchange Commission, and he said this, and I want to quote, and I want you to begin to see yourself in this quote right now. If a country does not have a reputation for strong corporate governance practice, capital will flow elsewhere. If investors are not confident with the level of disclosure, capital will flow elsewhere. Who will make disclosure possible in organizations, if not the accountant? If a country,
Mr.
yes,
Apologies, please, sir. Apologies. Olamide Balogun here, the chairman. Your presentation is poised to be very, very inciting and highly educative. However, a lot of our members can't really hear you clearly. I think maybe if you don't mind moving closer to your mic, if you check the chat box, that's what a lot of people are saying, that maybe you need to speak a bit louder. We sincerely apologize for this, but please help us maybe increase your volume a bit. Thank you so much, sir. Thank you.
I don't think this is the volume because I'm actually shouting. Can I quickly also still change it in case it's changed?
Okay, Mr. Latishe, can we maybe give Mr. Falabi maybe like a minute or two to start. You're requesting to change your device. Is that what you said?
Yeah, I think so. If I can change
Okay.
again to the third one.
Now that you're speaking, the minute you said I think so, it's a bit audible, it's a bit better. So I don't know whether maybe you move closer to your system.
No, I
or-
didn't move. In fact, I even
Oh.
I even spoke. I think is the problem is general and it must be from
Okay. Because I just don't want the social by people who miss out because I can tell, like because a lot of people are actually saying the audio is a bit low, is a bit low from the
Yes,
chat
but
box. So
of course,
it's like a general thing.
I also observed that. That's why I changed. When I was listening to Dr. Afolabi, I wasn't hearing her. So I
Okay.
had to now
Because
change.
during Dr. Afolabi, we could actually hear clearly. I don't think we had any. So it might just be a network glitch. Maybe would you like to log out and log in again? Would
I
that
could try.
suffice? Mr. Alapishe, would that be an option? Okay, maybe we'll do.
Maybe.
Just to ensure
And
everybody's
maybe
carried along
this
smoothly.
time you can now be taking questions from Dr. Afolabi.
No, we won't like to break the flow of the program, but as you're speaking, I'm sure members, can you please just type in the chat box? I think Mr. Latunji's audio is a bit better now. I think so. It could be a network glitch, but okay. So don't let me pause your train of thought, sir. Thank you. Please go ahead. Thank you.
Okay. Commenting on the numerous corporate standards in the United States in 2001 and 2002, as I mentioned earlier on, Arthur Levitt, a former chairman of the Securities and Exchange Commission, said in a speech, if a country does not have a reputation for strong corporate governance practice, capital will flow elsewhere. If investors are not confident with the level of disclosure, capital will flow elsewhere. If a country asks for lax accounting and reporting standards, capital will flow elsewhere. All enterprises in that country, regardless of how steadfast the particular company's practices, may suffer the consequences. Markets exist by the grace of investors, and it is today's more empowered investors who will determine which companies and which markets stand the test of time. So at the end of the session, which is almost rounding up anyway, accountants will be able to describe the sustainable corporate governance. When you're talking about sustainability, you're talking about what lasts at least into the future. Anytime you see a word sustainable, it means that what will make to work into the future is like taking the ongoing concern concept to the extreme. You know, the ongoing concern concept says in the next 12 months that this organization will not fail, this organization will not fight for bankruptcy, or is not going to scale down its operations on a very large scale. But sustainability has taken that now to the extreme that in the next 50 years, in the next 100 years, in the next 150 years, in the next 200 years, will this organization continue to be in existence? And if it's going to be so, then the corporate governance structure of the organization must be something that is extremely very effective. And to be effective, the accountants must play a very critical, a guardian role, in that effectiveness. Then you gain insight from the nature's horticulture for your roles in sustainable corporate governance. When you're talking about horticulturalism, you're talking about individuals who are schooled in helping farmers to improve their crops, to improve their plants, to improve the existence, of their farming. And in this case, the farmers are the board members. They are the board members, and the accountants are the horticulturists who are expected to help the board members to improve the governance structure of their organization. Then we'll now discuss the roles of accountants. Then the overview will be, talking generally about corporate governance and the metaphorical relationship between agriculture and sustainable corporate governance, then the roles of the accountants in corporate governance, which include the following. If we don't have time to go into it, just realize that these are actually the roles of the accountants in helping the organization to manage the corporate governance structure, the corporate governance systems that have been established. Driving organization long-term value creation, nurturing ethical practices and transparency, cultivating sustainability in corporate practices, integrating environmental, social, and governance principles into corporate strategies, strengthening internal controls and risk management, then fostering stakeholder collaboration, then case studies. I actually brought two case studies at the end of the slides. The one case study is the Satyam corporate failure in India. You know exactly how that organization failed because accountants and auditors actually failed them in their roles. Then you now see code 4, code 4 corporate governance of South Africa. There are 17 pillars, that make corporate governance work that they brought out. And when you go through all those 17 pillars, you know exactly what sustainable corporate governance is. I have actually given it at the end of the slides. We won't get there, but it's there at your own leisure. You can just go through them and you will see the components of sustainable corporate governance in Code 4 of South Africa. So those are the two case studies that I have brought to discuss with you. I want to talk about the synopsis, look at everything, the summary of what I have brought in the synopsis. Professional accountants play a gatekeeping and guiding role at all stages of sustainable corporate governance, from informing decision making and assessment and assessing investment scenarios to designing internal controls, measuring performance metrics, reporting and providing assurance. Accountants are well positioned to drive sustainable practices within their firms and client organizations. They can measure, of course, they are the only one that can actually measure and report on ESG performance, evaluate sustainability related risks and opportunities, and incorporate these insights into financial reporting and strategy. This paper is designed to inform accountants that as nature teaches us about the horticultural rules of farmers, they need to also position themselves accordingly to promote sustainable corporate governance in their organizations. The corporate governance system is expected to promote the effectiveness of monitoring, preventing, and dictating fraudulent acts, thereby improving the quality of accounting information. Studies have shown that corporate governance, well supported by the accountants, is the only one that can improve the quality of sustainable corporate governance. When I was putting together a book on corporate governance, I got to about 21 reasons why organizations fail globally. Why organizations fail in the UK, in the United States, and why organizations are failing in Africa. There are 21 reasons. And out of these 21 reasons, one that is very critical about it is the issue of financial reporting irregularities, the issue of creative accounting, the issue of auditors' compromise. We all knew what happened in Enron when Ato Anderson connived with the management of Enron, to nail that company and to fight for bankruptcy, a company that had been hitherto very, very healthy. So it is important for us to know that without the accountants, sustainable corporate governance can never be in practice. It can never happen. Now, when you're talking about sustainability governance, as I mentioned, we're talking about something that will last, something that will stand the test of time, something that is not going to fail. And today, corporate governance has moved towards sustainable governance. It has moved to how can we, as an organization, balance the planet with the profit, and with the people of the society. We have moved now from shareholder approach of corporate governance to stakeholder inclusive corporate governance, where all stakeholders with different and conflicting interests and rights and expectations are expected, to have not their interests jeopardized by the promotion of the interests of other stakeholders. For me, the summary of corporate governance is a subject that comes to ensure a balance between all the interests of all stakeholders, that the promotion of one interest is not jeopardizing the promotion of other interests. Meaning, there are minimum 9 stakeholder groups that organizations will have to deal with at any point in time. it doesn't matter which organization, minimum 9 stakeholder groups. And this includes the society, this includes the employees, this includes, the management, the board of directors, the debtors, the creditors, and so on and so forth. And the question is, how do we now balance the interests of all these stakeholders in such a way that one interest is not jeopardized by the decision-making system of the organization? And if this is so, and it is so, we have now moved towards stakeholder inclusive of corporate governance, that this in our decision-making system, let us now include the interests of all stakeholders, especially the society where the organizations exist. We must now include the welfare of the people, the welfare of the staff, the welfare of the environment. We must consider the earth. We must consider the planet earth, where we are taking all our inputs and we are also releasing all our products to. We must make sure that we are not degrading the society, we are not wasting, we are not releasing waste products into the society, so that we can keep and promote that environment for the future generations. Sustainability is actually, how do we meet the needs of this present generation while moving towards the realization of such needs of future generations? And this is the sustainable corporate governance there. And it's moving into the integration of environmental, social, and governance issues. The time of business as usual is gone in the Western world. It may not be gone in Africa, but definitely we are going to move to that too in Africa. In other words, organizations do not just exist to make profit. Organizations exist to cater for the welfare of the society and to balance the profit, to balance the planet, to balance the people together. We call it the 3 Ps, and that is the 3 pillars of sustainability. So that is the sustainable corporate governance. And if we are going to do that, there are a lot of things that the accountants need to know. And I'm quickly moving away. There are so many things in these slides, but somehow we cannot move beyond, this 30 minutes. But you can read them, and if you have any questions, you can actually, that is acceptable. Just moving straight to the empowerment of the accountants. I just hope that I'm hard. Accountants need to understand and incorporate the standardized environmental reporting frameworks into the accounting practices, whether they work as a government department, financial institution, or so. Accountants has a significant role to play in corporate sustainability auditing, measuring, reporting. They can ensure that reporting is accurate, uniform, transparent, and takes full account of environmental risk. Professional accountants are uniquely positioned to do this because they are the ones with the skill set, to manage the performance metrics that would come from ESG, which are the pillars of sustainable corporate governance. Accountants are the ones also to comprehensively manage the risks of the organization, because that is very integral to resilient, sustainable corporate governance. Then they are the ones also that will, of course, establish and create the performance metrics and targets to manage it. They are the ones also that will ensure transparency and the reporting guidelines for sustainable corporate governance. Accountants also provides financial information that stakeholders rely on to make informed decisions. The expertise not only enhances the accuracy of financial reporting, but also strengthens the integrity of the governance process. As financial stewards, accountants are tasked with the responsibility of maintaining the organization's financial health. Then accountants are also the ones that will prevent greenwashing. Greenwashing is the deception that sustainable corporate governance practitioners are engaged in these days. There are so many case studies concerning that we won't be talk about. And as I said before, this is the first case study from Sir Time Scandal. And this is the second case study from the principles of King 4 report of corporate governance. You know, what sustainable corporate governance practices should look for in every organization. There are 17 pillars. If you go through all this, you will have a very good grasp of what sustainability is or sustainability governance. I sincerely believe that I should stop so that I don't put myself under unnecessary pressure. So if there are questions to ask, then if there's any enlightenment to make, then we'll make it when the questions are asked so that you can maintain your 12, your noon. Because I actually listened to the chairman when he was giving the address that by 12 sharp we have to be, and we need 30 minutes to do the question and answer. I apologize that the audio is not working well, and I also apologize that we have to rush through this. And sincerely, there are a lot of things to learn from them, which we are not. Thank you so much, ladies and gentlemen.
Thank you, Mr. Olatunji. Are you through with your presentation, sir?
I'm true. I'm true.
Oh, okay. Oh, okay. Oh, thank you. Thank you very much. Mr. Alatishi, sir. Okay. Our members, we can go ahead to appreciate both our facilitators in the chat box. Okay, Mr. Alatishi, over to you, sir. Thank you.
Okay. Thank you, Mr. Latunji, for that presentation. Please, you can stop sharing your screen so we can take questions now. Okay, thank you, sir. So members, that was Mr. Latunji's wonderful presentation. Apologies for the, the audio quality. But hopefully, when you get the recorded link, you'll probably be able to get a much more clearer, or maybe with your a member said he used his earpiece and it was better. So hopefully, when we get the recording, we'll probably be able to piece it together and possibly more later be able to have. So if you have questions both for the first presenter and the second presenter, slides will be shared once this session is concluded. But if because of the low quality of the audio, we won't be able to ask any questions now, you can take your questions thereafter and send them over to the facilitators, and they will probably be able to get us responses to them. But for those of us who heard them clearly and who have questions now, the floor is open for the next 10 minutes for us to take your questions. Just use the raise hand option of the Zoom, and I'll be able to call you out and unmute you to be able to speak or ask your question. But if you don't want to speak and you want to type it out, I'm equally available to read them out. So while waiting for those to raise their questions, I have one question from Joshua Okun. What is the difference between sustainability and going concern concept? I want to believe that question is meant for Mr. Olatunji.
Yes. Sustainability actually is the ability of an organization to sustainably manage its organization into the future. Is actually a definition given by Brundtland in 1987 that every organization must meet the needs of the present generation, the present society, the present people, without jeopardizing the resources to meet the needs of the future generation, right? And that actually is taken from the ongoing concern concept. The ongoing concern concept of an organization is simply in the next 1 year, directors are expected to give a guarantee, to the investors that their organizations will not scale down in operations, at least on a large scale, and at least in the next 12 months, in this financial year. Then when it comes to the next financial year, they're going to give that too. So in other words, ongoing concern is now a little bit myopic than sustainability. Sustainability is now totally encompassing. Now, sustainability now means that the resources that are available is finite. Therefore, because it's finite, which of course also there's a query on that, but from what scientists have found out, they thought that resources are finite. And because it's finite, don't let's waste it. Don't let's degrade it. Let us keep it, let's protect it. And let us make sure that we are using it well effectively now in order to satisfy our customers now. Why not jeopardizing the future of this organization to satisfy the customers also in the future? So let's be responsible. And this also takes us to the issue of ecological footprint, that every organization must make sure that every place that your foot touches, you are maintaining it, you are sustaining it, and you are keeping it. And that also has moved to the issue of ecological, environmental, social, and governance issues, ESG. So that is just the difference. The difference is just about the timing, but they are always almost talking about the same.
Okay, thanks for your response. I hope Mr. Joshua Okun got the clarification he required. So I have another question for Dr. Afolabi. Apart from the tax treaties, what else do we need to advise in transfer pricing and international tax? That's from Ose Remen Dan Ugumoko. Dr. Afolabi, I hope the question is clear.
Yes, it is. Thank you very much. Please, can you hear me?
Yeah, we can hear you, ma'am. We can hear you, ma'am. Go ahead, ma'am.
The question is, apart from the tax treaties, what else do we need to advise in transfer pricing and international tax? Okay, so I want to try and explain. Both tax treaties and transfer pricing are international tax issues. So, tax treaty is a different body on its own, different from transfer pricing. So tax treaties are mostly implemented when there's an issue between a related party and parents, and you're trying to argue there is no permanent establishment. So there are different terminology. Transfer pricing and tax treaties don't work hand in hand, but they are both international tax issues. So the question now will be, what are other subtopics under international tax? Because one is tax treaty, two is transfer pricing. Then the three could be the global minimum tax, which is still under the body of transfer pricing. That's why the two major parts are tax treaties and transfer pricing, because every other like base erosion, profit shifting too is a very important international tax issue, but it still traces its way back to transfer pricing. So that's why there are majorly two, but so many subs under them. So that's what I would say concerning the international tax. Everything is still under the umbrella of mostly transfer pricing, while tax treaties, it just has to do with Nigeria and the countries we have tax treaties with, dealing with each case per country. So that's how I'll explain this. So every other thing is still under these two umbrellas, but there are so many subs under those two umbrellas for international taxation.
Okay, thank you, ma'am, for the clarification. I hope the member that raised the question got his or her clarification too. Any other questions? Our time is fast spent and we don't want to keep our facilitators or other members waiting. Anybody wanting to ask questions by raising their hands? I've not seen any. So I guess we don't have questions for our facilitators, but if, after listening to the session again, you still require further clarifications, feel free, to send your question into the district technical committee, the same handle that sends the Zoom links to you. You can send your questions there. We will collect them and send them to our facilitators. And immediately we get their responses, we will get back to you via the same medium through which you send the questions. Thanks once again for your time. So we now call on our district vice chairman, who will give vote of thanks to our facilitators. Alhaji Aditayo Azan, over to you, sir. If you are speaking, you are muted, sir.
Thank you, Mr. Latise. No doubt the two speakers have spoken laudably. I value the first speaker, very audible, very apt, and an area of international taxation which we can all explore into. And I believe that all those of us who are active must have gained extensively from the discussion. For the second speaker, unfortunately, many of us could not hear him because it wasn't audible enough. And I'm hopeful that by the time we get the presentation, we'll be able to take more from that. That notwithstanding, I believe this is something we need to all key into, because no knowledge is wasted. Every time we learn one or two things, it may not be useful to us immediately now, but one time or the other in the future, we may find them handy. And having this knowledge will make our job easier for us. So I want to thank the two speakers for their presentation, and for those who listened and who joined. I want to encourage them that they should partake in future webinars and make sure that they keep on enriching their knowledge. And for us, I think we should go and have a happy weekend. Thank you. Thank you.
Thank you, sir. Our Vice Chairman, Alhaji Azan Aditayo, for that vote of thanks to our facilitators and members as well. We will now call on our Technical Secretary, Alhaji Siaka Balogun, who for some information relating to the district activity. Over to you, Alhaji Siaka Balogun.
Oh, thank you, my able moderator. Thank you for a wonderful time. Firstly, I will appreciate, I'm here to do that, to appreciate our facilitator for their wonderful time. From Dr. Mr. David, we thank you all. To all our participants, once again, I thank you for your participation, most especially those people who have been joining us regularly. We are here to inform you that regularly at every month that day we shall be organizing an interesting topic for every month like this. Last Saturday of every month. That is that, and our meeting comes up every second Saturday at Lagos State University College of Education, Lagos State University Solo, and usually on High Bridge. And I appeal to everybody to continue patronizing us, most especially when the prices have changes. We shall communicate to you how to review the prices of whatever. But we still thank you, and more especially for those of you in the country and outside the country, can still join us to be a member of our district. You can join us on the live, either you're in the country, distance is not a problem. You can join us. Our meeting comes up every second Sunday, and we usually come up with technical season every meeting, which is the second Saturday of every month. But for this coming up month of February, we may, but we'll get back to you because of the webinar, Southwest webinar that are coming up. We may not have a webinar for the month of February, but for subsequent month, you shall duly inform. We thank you. We appreciate you for your patronage. And every time we thank all our resource persons for this time, wonderful time. And I thank my team for tirelessly using their time to support the team for to achieve this dream. And more especially in this our chairmanship year. Oh, thank you. Have a wonderful day. Have a blessed weekend. Thank you, everybody. Thank you, my colleagues. Thank you, my dear professional. Thank you, everybody. I appreciate you.
Thank you, our technical secretary, for that vote of thanks as well as words of advice to our members. As we are gradually, winding up the session for today, in case, does the chairman have any closing remarks before we bring on the item to close the session for today?
Thank you very much, Mr. Michael Alatishe. We've thanked everyone, but we also need to thank you, Mr. Alatishe, Michael FCA. Thank you for moderating this program for us. Thank you for always being a consistent and dedicated member of the district. We appreciate you. And to all our members, please continue to support our program. We'll communicate how we'll navigate this going forward. And our venture, it's laid in your heart to partner with us in any way. Please feel free to reach out to myself or the technical secretary. To our facilitators, we're very grateful. Thank you, everyone. Have a blessed weekend. Thank you, sir.
Thank you, Chairman, for that word of thanks. And this is thanking every one of us that have stayed till the end of today's session. I'm sure we all have one or two things to have gained from the facilitators. The slides and the recording will be sent to our respective mails. Within the week as well, the 5 credit hours that you registered for will probably be credited to you. If you have further questions relating to any of the presentations, either in the material shared or the recordings, please feel free to reach out to the email handle that sent those information to you, and we will definitely get back to you, with the required information that we get from our facilitator. This is me signing out, and as we close out with the anthem of ICAN and the national anthem.
Let's go, ICAN fount of treasure in triumph of banner raised, standing stronger in harmony, building a land together. Dreams of a founding fathers, we are striving to attain our roads and values that we share. Through all ages be sustained. Institute of Chartered Accountants of Nigeria. Noble ICAN, your accuracy we cherish. We uphold your integrity.
The national anthem.
Nigeria, be healthy, our own dear native land. No tribe and tongue may
Okay. Thank you, everyone. See you next time.
Thank you, everyone. We're grateful. Thank you, Dr. Afalabi. Thank you so much, ma. God bless you. We're grateful.
Very much.
Hello, thank you, everybody. Oh, thank you. Thank you.
Can our members unmute? Can you let them unmute for those who just want to say one or two things before we get off? I think we have about maybe 10 minutes. Thank you, our elders. I can see Elder doing Elder Tumade, Elder Gomo, everybody in our elder here.